well, this is a cheap way into the gold bull market. I mean, I think what's going to happen is that the silver price could explode. People who try and trade gold and silver lose money, full stop. Gold and silver will go lower before they go higher. If you look at open interest on COMEX, it's the lowest it's been for 20 years, both in gold and also silver. The speculators haven't bought it, so they're not there to sell it. The risk is in credit, not in gold and silver. Gold and silver are legal money. If I'm going to buy gold, I'm sacrificing income. The ETF gold exposure in that is only 0.2%. And yet here we have China clearing out any liquidity in the gold market. What could possibly go wrong? Now, China has accumulated an awful lot of silver. She's second or third producer of silver. Now, quite a lot of the silver comes from refining non-ferrous ores, particularly copper ores and nickel ores. So she has been accumulating silver at a far faster rate for a long period of time than she has been exporting silver. She has been the provider. These are fundamental factors which are really affecting the market for silver. This is not yet reflected in paper markets, particularly COMEX futures. In the same way, I suppose, in a sense, as the oil crisis hasn't been reflected as much as you would expect in terms of COMEX prices, futures values for oil. So that is something I think that is likely to come. And then there is the added kicker that as gold begins to move higher, which, as I've described, I think is not too far off, then under those circumstances, silver will be seen by retail investors in particular as the cheap way into the gold story. So you've got a combination of silver being withdrawn from the global market, creating an enormous shortage, forcing industrial users to pay up for silver. And at the same time, you're going to have amateur investors, if you like, thinking, well, this is a cheap way into the gold bull market. I mean, I think what's going to happen is that the silver price could explode from the combination of those two factors.
Right. If you look at time frames, Alasdair, would you be surprised to see silver lower or flat for the next 12 months?
I think over the next 12 months, I think things are changing so rapidly that this is actually a relatively immediate problem. I don't like giving timescales on these things, but it does appear to me that things are going to move a lot more quickly than that. I suspect, I don't make forecasts, but I suspect that we're likely to see this really happening. Perhaps in a matter of a month or two, or even it could even be weeks.
Markets keep telling investors silver is calm, while physical demand is behaving like supply already broke. As Alasdair Macleod points out here, the disconnect is not price versus fundamentals. It is paper liquidity versus physical availability. When industrial users compete with retail flows, futures markets can lag until confidence suddenly reprices. The danger for wealth preservation is not missing a perfect entry, but assuming price discovery still reflects underlying conditions. Next, Alasdair Macleod reveals why credit-fueled optimism and commodity scarcity cannot coexist indefinitely.
I mean, this is the problem. If people think they can fine-tune this. Oh, Elliott Wave says it's going to go down to whatever level you want to say. And what happens? You don't buy it. And the next thing you find you're sort of looking at $100, $200, whatever, saying, oh, damn it, I've missed it. The stupid thing is to think you can trade it. I mean, the statistics show that people who try and trade gold and silver lose money, full stop. Don't trade it, just stack. Just go with the flow. Go with the trend. If you can understand actually what's happening behind the scenes here, then that should be your guidance, not penny pinching, if you like, for, few bucks here, few bucks there. I mean, that's just stupid.
Yes, if we could also cover the stock market, Alasdair, and the importance of stock market for gold and silver as well. We have the SpaceX IPO investors stock markets are going higher, investors expect happiness and joy ahead of us. Is that something that you see? And if markets do go lower, how would that affect the precious metals markets in your view?
I think it's sort of rather the other way around. The problem that stock markets have is that they're being fueled by credit. If you look at the FINRA margin statistics, there is brokers' loans are a record high of about $1.2 trillion, having risen from around about 250 to $300 billion in the last 15 years. Now, that is only part of the story.
Stock indexes keep printing confidence while leverage keeps printing fragility. And those are not the same trade. According to Alasdair Macleod, margin debt reaching historic levels matters more than headline enthusiasm because borrowed liquidity can disappear faster than it arrives. The uncomfortable question is whether investors own assets or simply own access to credit. For long-term savers, the real risk is discovering diversification was built on the same financing cycle. Next, Alasdair Macleod exposes the hidden leverage sitting behind market strength and why institutions watch bond yields more than headlines.
Hedge funds have leverage of a further $7 trillion, both loans from banks, if you like, and also by operating in wholesale money markets such as the repo market. So you can see there's an awful lot of credit puffing up this market. Those are the conditions, basically, which we would call a bubble. It's quite simple. Now, if you look at what's happening to bond yields, and you just need to look at the chart. Bond yields are knocking on the ceiling of about 5%. In America, in the UK, countries like France, Italy, and so on and so forth. So most of the G7, you're looking at that 5% level. When we break through that on the upside, that's going to kill the equity market. You will get a crash. And then all that credit has to be unwound. You will find that banks are completely merciless when it comes to selling collateral when their loans become uncovered. So we've got the potential, I think, for a stock market crash there, and I would expect that to happen due to rising bond yields. Where gold and silver in this, I don't think there is any relationship between what's going to happen in equities and gold and silver. You would like to think, if you went back to the Lehman crisis, you'd like to think that under those circumstances, gold and silver will go lower before they go higher. There were very different circumstances. The bubble was in property, not in stocks. Admittedly, stocks got hit very hard. But at the same time, there was quite a lot of bullishness, if you like, in gold and silver. Particularly gold, which had run up to $1,000 an ounce for the first time in history, from around about, $250 as a low.
This happened before prior unwind phases too. Markets looked strongest just before liquidity stopped compounding. What Alasdair Macleod is highlighting is that rising yields do not simply reprice bonds. They pressure every asset funded through leverage. A market can survive expensive valuations longer than expensive financing. For investors protecting wealth, the threat is not volatility itself, but forced liquidation cycles that erase years of gains quickly. Next, Alasdair Macleod unravels why this cycle may break differently from 2008, despite superficial similarities.
257, I think, was the low back in 2020, 2022. So, or 2002 rather. So you can see that this is a very different situation. If you look at open interest on COMEX, it's the lowest it's been for 20 years, both in gold and also silver. The speculators haven't bought it, so they're not there to sell it. Very different situation. And I would just look at the big picture, and my conclusion is really quite simple. The risk is in credit, not in gold and silver. Gold and silver are legal money without counterparty risk. You want to get away from counterparty risk. That is the key. Equities are credit because you are giving management the credit to deliver you a stream of income or returns, which is yet to be promised in the future or let to materialize in the future. That is a form of credit. It's not an escape from inflation. So gold and silver, I think, are likely to perform very differently this time from the 2009 to 2012 experience. And I think we're going to see inflation measured by CPI a lot higher. And I don't think that's been even filtered into the markets yet. I really don't. So those bond yields are going to go up. When they break that 5% level, I see very little to stop them going up and up and up, particularly with the very high levels of what is rapidly becoming unfundable government debt to GDP.
Investors keep calling metals risky while holding portfolios that depend entirely on someone else keeping a promise. Alasdair Macleod's argument suggests the bigger vulnerability is not commodity volatility, but the assumption that credit always rolls over. Low speculative participation changes the equation because panic selling pressure may already be limited. If inflation and refinancing costs rise together, portfolios built for stable rates could face a very different decade. Next, Alasdair Macleod reveals why higher rates do not automatically weaken precious metals, despite what investors were taught.
I spoke to Michael Howell recently, and he emphasized the correlation between gold price and Chinese liquidity, which is fascinating, really, meaning that Chinese do control gold market to a very large extent. So thank you so much for sharing that, Alasdair. If we could look at interest rates. So inflation in US is going higher, which means that logically speaking, interest rates should also go higher. And many people believe that higher interest rate is very bad for precious metals. But if you look at the 70s, interest rates were going higher while we've seen one of the biggest bull markets ever in precious metals. So if we could talk a little bit more about that.
Well, again, if you go back to 1973, late 73 into 74-5, we saw exactly this phenomenon. I mean, believe it or not, in Japan, in 1974-5, inflation measured, this is at the consumer level, went up to 30%. 30%. Now, bond yields didn't go that high. I think they topped out around about 8%. But you can see, I mean, in the UK, the inflation rate went to around about 25%, and gilt yields went up to 17%, 17.5%. So, yeah, there is a correlation between the rate of inflation and bond yields. And it's a very worrying one at that. Now, under those circumstances, I think what happens is you get a shift, if you like, from this sort of idea that, if I'm going to buy gold, I'm sacrificing income. And if the rates are going up, I'm going to be sacrificing more income. So it's not good for gold. That sort of thinking quickly moves over. And I think it'll catch a lot of people by surprise into, my goodness, the risk actually is in credit.
The biggest investing myths usually survive because they worked once, not because they remain true. This is where Alasdair Macleod's thesis shifts from price forecasting into capital behavior under stress. Rising rates only hurt metals if investors still trust nominal returns more than purchasing power. When inflation outruns yield expectations, the market stops chasing income and starts searching for escape routes. Next, Alasdair Macleod exposes the historical blind spot that caused investors to miss previous commodity cycles.
We've got to get out of credit and get into real money and at least protect ourselves, have 5, 10, 15% gold. I mean, the point about the level, I mean, we don't know what level. I would say that you get out of every bit of credit you can possibly get out of. But when you look at North American portfolios, which are estimated to be worth about $160 trillion in total, the ETF gold exposure in that is only 0.2%. So the level of gold ownership, if you like, against this event is as close to zero as you can get. And yet here we have China, for various reasons, clearing out any liquidity in the gold market. What could possibly go wrong?
Yes, if we could look, Alasdair, at silver and mining stocks. So would you expect silver to follow gold when what we have just mentioned happens? And how do you view mining stocks at the current levels? Because some of those high-quality companies are doing very well at current commodity price.
Yeah, well, I mean, first, I'll just make a general comment on mining stocks because I don't follow them. I'm no longer in the business, if you like, of persuading people to buy or sell anything, any stocks anyway. I mean, yes, what they found is that the value of the silver and gold that they mine have been rising faster than their input costs. So yeah, their margins are brilliant. It's lovely, and doubtless it will continue. I don't want to make further comments on mines. I mean, there are a number of aspects which I think people have got to consider, and I'll leave that up to them.
Everyone says diversification matters until they discover almost nobody owns the asset meant to diversify systemic risk. As Alasdair Macleod points out here, extremely low portfolio exposure means even small reallocations can have outsized effects if sentiment changes. Institutions talk resilience while remaining concentrated in credit-linked assets. For everyday investors, the uncomfortable realization is that protection often becomes expensive only after demand appears. Next, Alasdair Macleod reveals why silver's industrial role may matter more than its monetary identity.
I'd just like to focus more on the prospects for gold and silver. And if we look at silver specifically, it's really an industrial metal. Um, and it's against that background that the price has been managed, if you like, by China. Now, China has accumulated an awful lot of silver. She's second or third or second equal, if you like, producer of silver. Now, quite a lot of the silver comes from refining non-ferrous ores, particularly copper ores and nickel ores. Now, something like 56% of mined silver in China comes, well, anywhere actually, comes from those ores. So she has been accumulating silver at a far faster rate for a long period of time than she has been exporting silver. If anything, in about the last sort of 10 years in particular, she has been the provider of liquidity, physical liquidity in the silver market, in the global silver market. And it's that supply which has meant that if you look at the Silver Institute's numbers, that's made up the deficit in supply, as it were, due to excess demand. Um, we're talking about growth industries, photovoltaics, electric vehicles, military applications, data centers, which increasingly are taking huge quantities of silver, etc., etc. Now, if we go back to the third quarter of last year, something very interesting happened, and it was really two things. The first was China decided to severely restrict exports of her rare earths. Now, the reason for this was that President Trump was threatening her with 100% tariffs. So she said, right, that's your attitude, no rare earth. Trump backed down. Okay, that worked. But what we didn't know at the time was she was also doing the same thing with silver, unannounced.
Markets celebrate AI growth, but rarely ask which raw materials make that growth physically possible. According to Alasdair Macleod, silver's story increasingly looks less like a precious metals trade and more like a strategic resource competition. The contradiction is that governments encourage electrification, while supply chains tighten behind the scenes. Investors ignoring industrial demand may be underestimating where scarcity appears first. Next, Alasdair Macleod exposes the policy shift that may have changed silver flows without attracting public attention.
Now, the reason for this is quite clear, and that is it was about that time that America announced that silver would become if you like, classified as a critical mineral, and therefore the Trump administration would look to accumulate physical silver, having run down their stocks to virtually zero. So was China going to supply America with this silver? No, no way at all. The change in policy, which would have come at the same time as rare earths, which was second half of September last year, led to a supply squeeze on the LBMA. I think it was on the 9th of October, when the lease rate ran up to 40%. and there was a real crisis. And that was the beginning of the move in silver prices from over $50 an ounce up to a peak of 120. So now that situation is still there, even though we've consolidated, we backed off, and we even went to almost half that peak, as it were, at one stage. Those conditions are still there. We're not getting our silver anymore. And indeed, if you look at what China has been doing in the first quarter of this year, she actually imported 1,628 tons of silver, turning round from a massive exporter for 3/4 of last year. So,
when governments start labeling materials as strategic, markets are usually the last to understand what changed. What Alasdair Macleod is highlighting is that supply stress often shows up in leasing markets and policy language before headlines catch up. Public narratives focus on price while institutions focus on access. For wealth preservation investors, the risk is waiting for confirmation after strategic positioning has already occurred.